Most people work for money, and every month their income resets as they return to the same cycle of effort, spending, and survival. A new month brings new work, and a new paycheck brings temporary relief, but the structure rarely changes. Financially successful people, however, operate differently because they focus on building assets that generate cash flow continuously, instead of relying only on active labor. These assets are designed to produce income over time, not just one-time profits, and that distinction changes everything about how wealth is created. True financial growth does not depend solely on trading time for money, but on building systems that continue working even when you are not actively working. Cash flow assets represent income-producing ownership, where money keeps returning through structured value rather than repeated effort. Common examples of these assets include rental properties, dividend-paying stocks, businesses, digital products, royalties, and investment funds. The goal is not simply to own something, but to own something that produces income consistently. This shift in thinking moves people from consumption-based financial behavior to production-based financial behavior, where every decision is measured by future value instead of immediate satisfaction. Another important principle behind wealth creation is scalability, because active income is always limited by time and energy. A person can only work so many hours in a day, but a cash flow asset can continue generating income repeatedly without constant direct effort. This creates leverage, where one decision or system can produce results far beyond individual labor capacity. The first step toward building cash flow assets is creating surplus income, meaning money left over after all necessary expenses are covered. Without surplus, asset creation becomes extremely difficult because there is nothing available to invest or build with. This is why budgeting and expense control are foundational steps in any serious wealth-building process. Once surplus income exists, the next step is allocation, which determines where extra money goes. Most people naturally redirect extra income toward lifestyle upgrades, but wealth builders redirect it toward asset creation instead. This single decision creates a long-term difference, because consumption removes future potential while investment increases future income capacity. After allocation comes the choice of asset types, and each category behaves differently in terms of risk, return, and effort required. Dividend stocks provide periodic income distributions. Real estate generates rental cash flow. Businesses produce recurring profits. And digital products can scale globally with minimal marginal cost. Understanding these differences allows for better long-term financial planning. Another core concept in wealth systems is compounding, where reinvested income creates accelerating growth over time. One asset generates income, which is then used to acquire another asset, gradually building multiple income streams. Over time, this process transforms small beginnings into larger financial structures that become increasingly self-sustaining. However, this system requires patience, because most cash flow assets take time to mature before producing meaningful income. In the early stages, returns may feel small or insignificant, which causes many people to quit prematurely. But consistent reinvestment and long-term commitment eventually shift the outcome from slow growth to exponential accumulation. Risk management is also essential because not all assets are stable or predictable in their returns. Markets fluctuate, businesses fail, and economic conditions change, which means relying on a single income source can create vulnerability. Diversification across multiple cash flow streams helps reduce risk and improve long-term stability. Over time, the goal is automation, where systems begin to operate with reduced manual involvement from the owner. This does not mean complete absence of effort, but rather a shift from active work to system management. Automation increases efficiency and frees time, which ultimately becomes one of the most valuable outcomes of financial independence. It is important to understand that even so-called passive income requires maintenance because properties need upkeep, businesses need management, and investments require monitoring. The idea of completely effortless income is mostly unrealistic, but strong systems can significantly reduce the amount of active involvement required to sustain earnings. At the core of all cash flow systems is value creation, because income only exists where value is delivered. Businesses solve problems, rental properties provide housing, investments support economic activity, and digital products deliver knowledge or tools. Money flows naturally towards systems that consistently provide useful value to others. This is why wealth building is not just about money itself, but about usefulness and problem-solving ability. The more effectively a system solves problems at scale, the more income it is capable of generating. Wealth is therefore a reflection of how much value is created and distributed in a structured way. Another important mindset shift is delayed gratification. Short-term comfort is sacrificed for long-term financial growth. Building assets often requires reducing immediate consumption in order to increase future freedom and stability. This discipline is difficult because results are not instant, but it is essential for long-term success. Ultimately, consistency is the most important factor in building cash flow systems, because most people fail not due to lack of knowledge, but due to early quitting. They expect fast results and abandon systems before they have time to develop. The wealth systems, however, begin slowly and then accelerate as they mature and compound over time. 3 major insights emerge from this structure. First, cash flow assets create recurring income instead of one-time earnings. Second, wealth builders consistently convert surplus income into productive assets instead of consumption. Third, long-term consistency and reinvestment transform small beginnings into large financial systems. In the end, the people who achieve financial freedom are not always the highest earners, but those who understand systems. They build structures that continue producing income beyond their direct effort. And that is what ultimately separates financial pressure from financial independence.